The May market was headlined by central bank rate hike to 13%. We saw a number of earnings releases and a whole lot of corporate news around the debt and the money market. Johnson Chukwu is a licensed trader and CEO at Carrier Asset Management, and he joins me now to review the markets in May and raise the curtain on the new month. Good evening to you, sir, and great to have you on the show again tonight on our Rice Exchange.
Good evening, Boston, and thank you for having me. Happy New Month.
Thank you so much. Thank you so much for your time. Give me a quick review of market last month. What were the key trading themes for investors?
In the month of May, you know that the month of May, May was the peak of the benefit season. So a lot of investors took positions in Nigerian equities with expectations or angling to get either cash dividend or scrip dividend. So it was like the market was on a steroid in the month of May, and the market recorded major appreciations across most segments or most sectors of the market. So the month of May was driven largely by benefit payment and the benefit season.
Tell me about some of the earnings in the period under review. We've seen an earnings from Flamis, for example, a very roaring result, posting 1.13 trillion naira for its full year ended the month of March. This is a very big result from a very big company, which was just concluding the acquisition of a majority shares in Honeywell Flour.
Yes, it is. If you look at the fact that Honeywell was able to grow its top line, which is revenue, by about 50%, and also recorded increases across all major parameters. It ended the year with a profit after tax of about 28 billion and a dividend of 2.1 naira, 2 naira 50 kobo. That's quite impressive. And if you look at the major things, so what we measure is that we saw a material appreciation of 50% growth in top line, which is revenue, although this was partly offset by a growth of about 58% in its cost of goods, which grew to about 1.0 trillion. But interestingly, the company recorded about 108 billion in gross profit. And like you said, it was coming at the period when it just finished acquisition of Honeywell. Although the Honeywell's performance was not as impressive as that of the now parent company, but it's expected that the performance of Flamis will rub off on Honeywell. Honeywell ended the year with a loss of about 1 billion, but I expect that will moderate in the subsequent years.
If you look at 2021, which flows into 2022 for Flamis PLC, let's stick with Flamis a little bit. This company reported growth across sugar, food, pastries, and other items. How do you think the company was? Was it more of consumer spending, or what was responsible for that, in your opinion? How did sales grow so to more than 1 trillion naira?
Yes, if you look at that growth, you realize that over 64% of the growth, about over 700 billion, came from food segment of their business, which means that there is a lot of demand for their food items. And why is it so? Because what we are witnessing is that we are seeing import substitution food items as a result of scarcity of forex. A lot of consumers are now eating or focusing on domestic food items, and that's where Flamis actually gained a lot. But on the other side, it has to also watch out for increase in its cost of goods produced. A major cost component is the increase in the cost of raw materials, and we should expect that to further increase in the current year because of the Ukrainian-Russian war. But in terms of the structure of their earnings, 64% of it was accounted by the food segment of their business, and that's over 700 billion of their 1.16 trillion revenue.
Okay, so here is, if we move to the financial services sector, the parent company of First Bank, which is FBN Holdings, posted robust numbers for full year 2021 and Q1 2022. Do you think this financial supermarket has turned the corner into what can be described as sustainable profitability?
Yes, if you look at the structure of their earnings, the company record, I mean, the FBN holding recorded a profit turnover about 757 billion naira, and ended the year with a profit about 151 billion naira after tax, about 166 billion naira before tax. But most interesting thing is that we are seeing a compression or a depression in their fund-based revenue, which is where the competition is. So what I think has happened is that the bank has changed its strategy. Instead of focusing on fund-based revenues, it's now focusing on service income, commissions and fees, which it grew by over 70% in the financial year ended 31st of December. And for me, that is actually a game changer, because when you shift away from fund-based income and focus on service-based income, is going to now take full advantage of its ubiquitous branch network, of its adoption of fintech technologies, of providing services to other channels of service delivery instead of the brick and mortar banking halls. And the cost of providing services on those channels are far cheaper than providing services through the banking hall. Again, by moving away from fund-based income and focusing on commissions and fees, which I said grew, it had a commission and fees of more than 360 billion, and that segment of income grew more than 70%, whereas fund-based income actually depressed. So you're going to see a bank that is now moving towards a sustainable income level, and that could also explain why its non-performing loan is declining. We saw a decline in non-performing loans to total gross loan from 7.7% to 6.1%. So in effect, it's actually getting to the point where it will be within the CBN advised limit of 5%.
Johnson Chukwu, we have an exclusive interview with Dr. Adesola Adedutan, the Managing Director and CEO of First Bank Nigeria, within the next 20 minutes or less than that here on the show. Keep that in mind. Don't go away. You can watch that. But let's, I spoke more about some of the things you spoke about this latest earnings and the strategies, how those numbers were achieved. But let's talk about Dangote Industries is looking to float multi-billion-naira bond to support its refinery facilities project. What's your take on that?
Well, I think Dangote is pushing for the conclusion of its refinery project. Clearly, the company is a bit leveraged or relatively leveraged, but at the point where it looks like it's on the last lap of the funding for the refinery. And the group, because when you look at Dangote Industries funding PLC, that is coming to the market to raise about 300 billion naira to support for investment in the refinery. And also at the same time, just last month, Dangote Cement also came to the market and raised 116 billion of its 300 billion naira funding arrangement. So in effect, between Dangote Cement and Dangote Industries funding PLC, the group is raising about 600 billion, which is an equivalent of about 1.2 between 1.1 and 1.2 billion dollars, depending on the exchange rate you use. So, and I think this is geared towards the last lap of its funding needs to ensure that the refineries come on stream. So I want to believe that because it's a group, they could actually be intergroup lending. So even if Dangote Cement borrows, it can also avail Dangote Refinery or Dangote Industries some of those funding to ensure that this massive project that they've actually set out to achieve is brought to stream in the immediate future.
Are you going to be, are you bullish or bearish in the new month of June starting today? You got a few seconds for that.
Well, I think the market might correct a bit. You could see profit taking, which we have witnessed in the past few days. Again, we've also known that the MPC has increased the MPR by 150 basis points. That is expected to have a negative effect on equity prices as investors switch their portfolios from equity instruments to fixed income instruments.
Johnson Chukwu, licensed dealer and CEO at Carrier Asset Management. Thank you so much for your time this evening. Have a pleasant evening. Thank you.